Hello everyone, and welcome back to the Quant Lab. In the beginning of this chapter, we defined dense trading zones. We looked for areas where prices consolidated sideways over multiple days or weeks, allowing institutional capital to slowly build an average cost basis. But massive institutional capital does not always have the luxury of taking weeks to establish a position. When a sudden macroeconomic catalyst drops, like a massive earnings beat or Federal Reserve rate cut, institutional algorithms flood the market instantly. They transact massive amounts of capital in a single session. Today, we are going to learn how a single isolated candlestick can instantly establish a completely new independent support or resistance floor. We are looking for a very specific structural anomaly, which we call a key K-line. To separate this from random daily noise, it must pass two strict mathematical filters. First, volume expansion. The daily volume cannot just be slightly higher. It must be an absolute anomaly. Our baseline quantitative threshold is that current volume must be at least 1.5 times greater than the 20-day simple moving averages of volume. Second, high structural density. The real body of the candle, the colored box between the open and the close, must be extremely long, dominating the day's range. Simultaneously, the upper and lower wicks must be short as possible. In classical Japanese charting, a candle with little to no wicks is called a marubozu. When massive 1.5 times volume perfectly aligns with a dominant real body, that single candlestick functions exactly like a multi-wick consolidation zone. A massive green body becomes an immediate support zone, representing aggressive accumulation. A massive red body becomes an immediate resistance ceiling, representing panic distribution. But there is a problem. A key K-line can span a massive price range. If a stock surges 8% in a single day, simplify saying the candle is support is useless for calculating risk. We need precise execution coordinates. Therefore, we mathematically divide the real body into three distinct horizontal levels: the upper edge, the midpoint, and the lower edge. Look at this diagram of a bullish key candle. The upper edge represents the aggressive, shallow by the deep level. The lower edge is the origin of the momentum. It is your ultimate hard stop loss. If the price closes below this base, the buyers are trapped at a loss, and the bullish structure is entirely invalidated. But the most important coordinate is the midpoint. Why is the exact 50% mathematical center of the candle the highest probability entry for mean reversion? Think about institutional execution. When a hedge fund buys 5 million shares over a single day, their algorithms do not buy all the shares at the absolute bottom or absolute top. They buy steadily throughout the entire session. Therefore, the mathematical midpoint of a dominant real body serves as the ultimate proxy for their average cost basis. If the price pulls back to this midpoint, that institution will aggressively deploy limit orders to defend their break-even price. Oh. Let's look at a textbook example on the daily chart of Tesla. On April 15th, Tesla prints a massive bullish K line. Look at the volume. Subchart at the bottom. It is a massive expansion, easily clearing or 1.5 times threshold. We take the real body of that single candle and slice it into our three level coordinates. The upper edge near $392, the midpoint near $380, and the lower edge near $367. Look at the price action over the next 3 entire months. Every single major pullback perfectly respects these 3 horizontal lines. When the price dips, it is aggressively caught by the 380 midpoint. Okay, for example, here, 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 and here, and here. This single day of volume dictates the exact institutional boundaries for an entire quarter of trading. Eventually, all trends die. By tracking these high volume candles, we can build an early warning system. We follow 3 strict rules. First, the temporal anchor. Institutional capital has a decaying memory. Always anchor your analysis to the most recent high volume candle. A volume anomaly printed 3 days ago is far more important than one printed 30 days ago. Second, the consolidation anchor. If the recent market lacks an isolated volume anomaly, look instead for the most recent sideways consolidation box. And third, the breakdown trigger. Your definitive warning signal fires the moment the daily price closes below the lower edge of your most recent key K line, or below the floor of your recent consolidation box. This breakdown mathematically confirms that localized momentum is dead, and the asset must fall to find fresh liquidity. I will leave you with a final warning regarding volume. When searching for your 1.5 times volume expansion, you must actively filter out options expiration or OPEX days, specifically the 3rd Friday of every month. During OPEX, and especially quadruple witching days, volume routinely explodes to 200% or 300% of average. But this volume is fake. It is driven by market makers, delta hedging, derivative books, and settling expiring contracts. It is not directional institutional accumulation. If you anchor your structural support to an OPEX Friday candle, you will be violently stopped out. Treat OPEX volume as an anomaly and discard it from your matrix. For delta hedging, what is delta, and how we make play with delta hedging. We are going to cover this in later chapter, in option chapters. All right. In our next session, we will conclude chapter 3 by mastering price gaps. See you in the quant lab.